Good morning, everyone. My name is Bong with metric number 84208. Today, I will present my FYP, which is a treasury bond as moderating variable on the effect of GDP, interest rate, and inflation on stock market performance in Malaysia. A 1981 to 2020 analysis. Stock market performance. The stock market reflects economic stability influenced by GDP, interest rate, and inflation. A strong GDP can boost stock market performance by higher profit and investor confidence. Higher interest rate can reduce stock price by increasing borrowing costs. High inflation can lower purchasing power and stock price, while moderate inflation support growth. Now is the treasury bond. I use treasury bond in Malaysia, which is Malaysian government security. Is a long-term bond issued by the government. Now is the problem statement. In Malaysia, GDP, interest rate, and inflation direct effect on the stock market are well documented, but the role of treasury bond in moderating this impact remain under study. Previous study has explored macroeconomics influence on Malaysia stock market and examined the interaction between stock market and government bond globally. However, no research has specifically addressed the moderating roles of treasury bond in Malaysia. This study is aimed to analyze how treasury bond influence the relationship between GDP, interest rate, inflation, and stock market performance. The objective of this study is to examine the moderating effect of treasury bond on the relationship between GDP, real interest rate, and inflation stock market performance in Malaysia over the period from 1981 to 2020. And this study has 5 specific objectives. The first one is to investigate the effect of GDP, real interest rate, and inflation on stock market performance in Malaysia. The second one is to identify the role of treasury bond as a moderating variable in the relationship between GDP and stock market performance in Malaysia. The third one is to analyze the moderating effect of treasury bond in the relationship between real interest rate and stock market performance in Malaysia. Then is to examine how treasury bond moderate the impact of inflation on stock market performance in Malaysia. And the last one is to examine the effect of treasury bond on stock market performance in Malaysia. Resource hypothesis. The resource hypothesis is based on 5 specific objectives. For example, hypothesis 1, for the null hypothesis, GDP, real interest rate, and inflation do not significantly affect stock market performance. For the alternative hypothesis, GDP, real interest rate, and inflation significantly affect stock market performance. Now move to significance of the study. This study provides insight for investors on using treasury bond during economic uncertainty and help policymakers design fiscal and monetary policy for economic stability. This study also encouraged further research on financial instrument roles in risk mitigation across diverse economic contexts and emerging markets. Literature review. For the literature review, I found 30 articles, but I just take 5 as my example. For macroeconomic variable on stock market performance, Yusuf and Baruddin, 2022, found that GDP and inflation positively affect stock performance, while interest rate negatively influence stock market. For government bond on stock market performance, Fan and Chan, 2017, found that during market downturn, the correlation between stock and government bond become negative. Theoretical frameworks. I use two theory, which is arbitrage pricing theory. APT suggests a linear relationship between asset return and macroeconomic factors like GDP, interest rate, and inflation. This theory used to explore how Treasury bond can moderate the impact of these macroeconomic variables on stock market performance, like KLCI. Modern portfolio theory. MPT emphasized portfolio diversification to optimize the risk-return trade-off. This theory used to investigate how Treasury bond can mitigate stock market volatility caused by macroeconomic change, highlighting the importance of low correlation between bond and stock in portfolio stability. Target population. This study examined the moderating effect of Treasury bond on the relationship between GDP, interest rate, inflation, and stock market performance in Malaysia from 1981 to 2020 using secondary data on CIC over a 40-year period. Sample size. The study used secondary data from 1981 to 2020, sources from CIC, covering economic variables such as GDP, real interest rate, inflation, stock market performance, and treasury bond. For the conceptual frameworks, the dependence variable is stock market performance, which is KLCI. The independence variable is GDP, real interest rate, inflation, which is CPI. The moderating variable is treasury bond. Data description. Stock market performance, GDP, treasury bond is measured by MYR millions, and real interest rate, inflation is measured by percentage. Research model. This research has used descriptive analysis include mean, median, standard deviation, minimum and maximum value for variable, which can to identify the trend and pattern for further analysis of their relationship. This research use OLS regression. This model is to determine the optimal regression line that predict the dependence variable by minimizing the sum of square residue between the observed and predicted value based on one or more independence variable. This study has baseline in question and full model with treasury bond as moderating variable. This study used unit root tests to transform non-stationary series into stationary one for better prediction and analysis. The study also used granular causality tests to determine whether one variable provides useful information for predicting another variable, which aid in model building and economics analysis. This study also used diagnostic tests to identify issues such as autocorrelation, heteroscedasticity, normality of residues, reset test, and multicollinearity. This study also used stability tests, for example, Kusam test and Kusam or square root test, and impulse response function to analyze the impact of one-time shock in macroeconomics indicator on stock market performance. The last one is variance decomposition, is to clarify the relative importance of each variable in influencing stock market performance. That's all from me. Thank you for listening.